Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week, it's the end of the year tax planning for 2013. And on today's show, how income is taxed. And with me is certified financial planner and CPA Ken Davis. Hello everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to day 2, Ken, in our series saga of taxation. And we talked about some of these things. If you missed some of the layout, we talked about exemptions, deductions, credits. We talked about different ways the tax brackets are. Is it marginal? Is it blended? Is it effective? If you haven't seen that, go back to our site at downtobusiness.ashbrokers.com and you can watch that. I think it's a good building block to not come in on Tuesday, but go check out Monday's show to make sure. And what we're talking about today, of course, is we're talking about how income's taxed. Well, let's find out what kind of income do we actually have? To me, that is a real question, because I always think, and I think most of Americans do too, they just go, I have W-2 income, I have my interest at my CDs, and if I hold my investments longer than 2 years,
1 year.
Or 1 year, I'm sorry, I have capital gains. That's the way it is. But there's so much more to this.
Well, that's exactly right, because whether something's considered salary or not may determine whether or not it's subject to the FICA taxes. Mm-hmm. There's certain kinds of interest generally is not deductible, but in certain circumstances with your investments it is. And whether it's a W-2 income or a small proprietor that flows through Schedule C, all of these definitions and these categorizations have an impact on the end result of tax. So, most people's situations are pretty simple. They just, do their W-2, although the middle class wage earner can be impacted by the taxation of Social Security income, as we've discussed in other shows. But you have to know what these categories are, because they do flow through the return and they do have impact.
Well, let's talk about it for a second, because I think everybody understands, hey, if I'm working for an employer, I have W-2 income.
Right.
Some people actually may be a consultantor and they're getting a 1099 from other companies and their various places that they partner with. Right. So I think everybody's kind of aware of that.
And that's generally how you make a differentiation is if you're getting a W-2, then you know it's wages and it's categorized for you. The employer is already determined what the tax implication is, and they run it through the W-2, and then you're told which lines on the tax return to utilize that for. 1099 is different kinds of income. It's self-employment income, consulting. It's also dividends, interest, pension distributions, and there's different 1099s for different kinds of categorizations.
And one of the reasons why we're talking about this is because the tax advantage products that we sell have huge impact on your 1040 and how it deals with income, especially depending upon how it's generated. We'll talk a little bit about that towards the end of the week.
Let's back up real quick. Let's take a view from of the forest instead of the trees. What happens is that we've been conditioned to think about finding tax deductions. Okay, that's what everybody wants, is the upfront tax deduction. What we have in our products with annuities and life insurance, et cetera, is tax deferral. And you might think, oh, tax deferral isn't as good as tax deduction. It just doesn't feel as good because it takes time for it to work. The fact of the matter is if you look at a Roth IRA and a regular IRA, you assume the exact same tax rate up front, same tax rate on the back end, which isn't true, but assuming it was true. The net effect and the same earnings rate for both, there is a strong case to be made that the end result is exactly the same. That
so
the same spendable
future,
after tax.
They're gonna really coalesce.
Right.
Okay.
So, and then of course Roth has other features that actually makes it more attractive, especially to wealthier. But the point is that tax deferral is a very powerful tool.
I want to talk about AMT because this is the hidden tax. Now they made some adjustments now. It's a little bit, they finally caught up. I remember last year, I think it was the year before, you and I were saying they never inflation adjust the AMT. So now all of a sudden we've kind of had a kind of a rescue here. Talk a little bit about the AMT and the alternative minimum tax and how it hits what they used to say is affluent. It's still coming down to the middle class.
Yeah, the intention of alternative minimum tax is people were complaining about all of the tax planning that the wealthy were doing. They're hiring their attorneys and tax accountants, people like myself. that would then say, okay, if you do it this way, you'll get these deductions, these exemptions, these credits, whatever. And then they would, borrow money to buy them, so they leverage them up and multiply them. And when you had, remember the chart with the real high tax rates? Well, it was really important that you went and found those deductions, and tax shelters were the big deal. Well, that's all been shut down. A lot of the deductions have gone away, all that kind of planning's gone away. So now what is left really? Well, IRAs and qualified plans can make deductions. But now we're back really to tax deferral. So that's really the state of where we are in terms of planning.
Well, we're towards the end of the year, and people are looking at their capital gains and their capital losses, trying to see if they can harvest some of this and try to negate any of the taxable issues. Capital gains, talk about that and define it.
Well, the big deal in capital gains is the long-term capital gain rate has been traditionally, in the last number of years, about 15%. For those in the 39.6% maximum bracket, they're now pushed up to the 20% cap gains rate. They've made it even more complex by having a variety of things for collectibles, things for recapture of depreciation on property, etc. But generally, you're talking 15 or 20%. Most people 15 max. And it can be as low as 0 for people in lower brackets. But those rates are based on long-term capital gains, meaning the asset that was a capital asset, like stocks, bonds, real estate, etc., have been held for at least 12 months and a day to make sure that they get the long-term capital gain rate, these lower rates.
So when I'm looking at W-2, 1099, I have ordinary income, I have capital, I have AMT.
You have portfolio income, you got passive income, you got all these different designations.
I tell you what, I think we have the most convoluted system in the world.
Yeah, I think you're
Well,
probably right.
we come back from the break. We're going to break down deductions, but more than that, taxable, tax deferral, tax exempt, and maybe tax free, so you can have a basic understanding of end of the year planning. And don't forget, you can request all our show documents that we use as sample examples from Backroom Technician at ashbrokerage.com. And you can sign up for your own 30-day free trial offer at BRT, Backroom Technician. Just go out to brtnow.com/trialsignup.aspx. We'll be right back with more with Ken Davis right after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back. I'm Steve Savant with Ken Davis, and remember you can watch all our shows of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, right out at ashbrokerage.com. Just click on the show logo and it'll take you right out to the homepage. And just a heads up, before moving forward with any of the ideas on our show, always consult your tax advisor or legal counsel as well as your broker-dealer compliance officer. Well, let's get down to business. We're talking about basic tax deductions, but I kind of want to talk more about taxable income, tax-deferred income, tax-exempt income, and then tax-free income, which is kind of a thing I want to kind of get to it a little bit. Talk about, well, you know what taxable income is? And most of the time when we're talking about that, it's ordinary income or capital gain. I mean, there's others, but I'm just saying majority.
Generally, that's true, yes.
Okay, so if I'm talking about our goal is what is taxable, and am I scoring that, after we talked on this yesterday's show, am I scoring that off my adjusted gross income at the bottom of page 1, or am I really looking at this at bottom of page 2 because I'm using modified adjusted gross income?
Well, actually, the bottom of page 2 is really where the tax is assessed, and then they take credits against it. Modified adjusted gross income determines whether certain things will be included that weren't included. For instance, generally we think of Social Security income as not being taxable, but it's not true. Up 50% has started to be taxable, and up to 85% of it's taxable, and it's all based on adjusted gross income on the bottom of page 1, which is then modified and added back Social Security, and what is considered tax-exempt interest income from municipal bonds is now back in play again.
When I think about taxable income, and I think about writing a check every day, or if you're a W-2, you have a certain amount of money taken out of your contract, and you look at that, and again, we talked about this, is what's the effective tax? What am I really paying? I start to look at things like tax deferral. Well, I don't want to pay that. I may not need that income now. Let's see what we can do to defer taxes, which is not, you're not getting out of the tax, you're just delaying the tax. But is there power in deferral like this?
Well, yeah, I think probably the best example when I'm trying to explain to 401k enrollees is what if you could go to the bank and you could borrow $10,000, interest-free, no interest on it, and you can go out and invest it somewhere, and all you have to do, and you don't pay any taxes on it currently as you're investing it, as long as it's in the investment account, it's all building tax deferred. It's the same kind of concept. And then the bank just says, okay, we're not going to charge any interest, but when you go to sell it, we want a piece of that action. We want some of that back from some of the earnings that you made. And so how many people would love to go out and borrow money interest-free and go invest it? Well, that's basically what the government's doing, is tax deferral is saying, we're not going to take your taxes now. You get to keep them. You get to build them tax deferred. And then when you finally cash out, we want our piece of the action. And that's basically what tax deferral is. So, yeah, tax deferral is really powerful. Yes, you have to pay taxes later, but you have extra money to compound that's building. And you and I both know that the difference in compounding over many years is huge.
Yeah, I'm thinking that tax deferral, depending upon how long your hold position is on whatever you have, this could be powerful and overcome a lot of the objections of paying ordinary income tax at the end.
Well, what's interesting is when I look at 401k enrollees, is if you build on a 7%, say, these are the days we used to make these kinds of returns, 10% pre-tax, 7% after tax. Well, if you're building at 10%, you basically have about twice as much money in year 20 or 21 than you would if you're compounding at 7%. So if you're 45 years old planning on retiring at 65, getting those tax deferrals is very powerful.
Well, when I think about tax-exempt income, I love that. A lot of people like municipal bonds for that reason. But we have to remember, some of this is federal, some of it's state, some of it's local. We don't know what entity. It may not be free at the federal level. Maybe it's only free at the state level.
Well, and what's interesting is to marvel at the machinations of the free market. If you compare municipal bond interest to taxable interest is higher, municipal bond interest is lower. Why? Because people bid up and purchase tax-exempt assets, and so they drive the interest rates down. So you have to be in a fairly high tax bracket before the tax-exempt helps. And interestingly enough, we've gone from high tax rates down to low tax rates during the Reagan years. Now we're back up again, and so all these deferrals and stuff become more and more important as the tax rate gets higher.
I'm also looking at tax-free. I'm looking at policy loans on a cash value life insurance contract kept in force for the life of the policy insured. And those don't even show up on the 1040. Is that true?
Well, yeah, that's true, and it's really more powerful than it looks. Think about a life insurance policy that's earning interest. Part of that interest is going to pay for the cost of the insurance. You can stop paying premiums. The internal earnings are paying for your cost of insurance internally. You're never taxed on that money, and it goes ahead and pays for something that you normally wouldn't get a deduction for. You don't get a deduction for term insurance premiums, but inside a cash value policy, you do. The earnings are tax deferred. And then there's something, this is, CPA geek speak, is at the end it becomes permanently deferred. What's that mean is if you hold it to the day you die, it becomes essentially tax-free. You earn the money, you got the use of it through tax-free withdrawals of tax basis, you get it through loans against the policy, and with a zero net cost loan type basis, you never pay any interest on it either. So yes, it is essentially tax-free if you hold it till the day you die.
And of course, all this is all based on the performance of the contract. It could be interest rates, indexing, or whatever we're using.
And the cost of insurance comes
and the cost
out.
Of
it
insurance.
is a life insurance policy.
Right. So we're paying for it, but to me, once you look at the actual interior costs against a long haul view, a nice long-term horizon, it could be a play. So taxable, deferred, exempt, free. Well, that's our show for today. Remember, you can read all my online insurance commentary, advisor blogs, and articles on Producers Web, and my answers to consumer questions on the Insurance Library. Don't forget to view all of our past episodes of any of our shows on our on-demand section located at downtobusiness.ashbrokerage.com. So you'll follow me at Twitter, Facebook, LinkedIn, or just email me, steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. See you tomorrow.